Hey, I think it's been a minute. Hello, everyone, and welcome to this expert group meeting on trade tensions and the changing global trade order, implications for Asia and the Pacific. So this expert group meeting is divided into two parts. The first one is impact assessment and implications of U.S. tariff measures for developing Asia-Pacific economies, and the second session is on policy options to navigate the uncertainty. So a few house rules. We are recording this for internal purposes. We will not release it to public just so that we can make notes. If you have an issue with that, please let us know. If you have any questions to the panelists, please put them into the Q&A box and we will try to answer them during the meeting. Please keep your mics off for the duration of the EGM. Again, if you have any questions, use the chat box. Our opening will be done by Dr. Armida Sasia Alisabana, who is the Undersecretary General of the United Nations Economic and Secretary United Nations Economic and Social Commission for Asia and the Pacific, and our Executive Secretary. Please, Ivo, the floor is yours.
Thank you very much. Very good morning, very good afternoon to all colleagues joining here for this very important EGM expert group meeting, which is very timely because the meeting will discuss on the trade tension and the changing global trade order. Very, very pertinent topics, and I mean at the forefront of everybody's attention as well as focus. Yeah, and as colleague knows, trade has long been a cornerstone of growth and development for us here in Asia and the Pacific. Actually, yeah, the growth and development progress that we have enjoyed during the past decades, yeah, have been made possible because the growth has been through the backbone of trade, investment, supply chain, as well as connectivity. This has been the backbone of our region. So of course now, with the recent and still ongoing trade and hence tariff, right? So-called exchanges or war here between the various countries. So therefore, we have seen a profound shift, deepening concerns over supply chain security, strategic autonomy, and technological competition are reshaping global trade patterns, investment flows, as well as regulatory frameworks. So trade policy no longer driven solely by economic efficiency, but is increasingly shaped by strategic priorities as well as geopolitical considerations. Again, on this note, we understand that the tariff, this tariff imposed, in this context is not only merely on tariff per se, but many, many other factors come into play, the non-tariff barriers and various other consideration comes into play. The global trade environment, once anchored in a rules-based multilateral framework, has become highly fragmented and is characterized by growing uncertainty over long-standing norms. For our region, these shifts are particularly significant. Our economies are deeply interconnected. Regional integration and value chain have amplified the benefits of globalization. And today, these same interdependence means that disruptions are also transmitted quickly across borders. So our analysis, and I'm sure your colleague will be able to share more a bit later in the discussion, that for some economies in the region, the value of exports at risk from tariffs is significant, equivalent to as much as 3 to 11% of their GDP. For the developing economies that have relied on open markets to drive industrialization, poverty reduction, and integration into the global economy, these changes raise fundamental questions about how future growth and resilience can be sustained. For example, the LDCs and the SIDS are particularly at risk due to limited diversification and also, the smaller market that they have, narrow industrial bases, as well as higher trade costs. So therefore, the impact, disproportionately more significant. So therefore, this EGM is, again, to reiterate, is very not only timely, but strategically important. I saw, from the list, of the speakers, is I think all the experts are here, and which to also, to contribute to the goal to deepen our understanding of likely scenarios, to explore how governments can better support businesses, particularly SMEs, in adapting to a rapidly changing trade environment, as well as to discuss what alternative pathways to the diversification, regional integration that might look like if global trade fragmentation becomes the norm going forward. So this is going forward. So again, I understand from the agenda, the first segment would be discussing on the impact and the implication of the US tariff measures. Although, based on this reciprocal tariff, although we don't know what the end would be, but at least one scenario would be, to simulate that. And secondly, this is very important, the policy options to navigate this uncertainty. So with that, again, thank you very much to our distinguished speakers, experts who have joined us today. Your insights will be very useful in shaping practical, forward-looking strategies for our region. And we will take all your suggestions, recommendations forward. Thank you very much.
Thank you very much, Ibu Armida. May I now please ask Dr. Rupa Chanda to take the floor and moderate the following session.
Thank you, Alexei. Thank you, Ibu Armida, for setting the context and highlighting why this EGM is particularly significant and timely. I think for us as trade economists, trade experts, trade policy former officials from the trade stream, this has been a very busy period. I don't think we've seen so much action in so little time. Extremely fluid. Every single day we hear new kinds of news, and it's difficult to keep track and keep doing the impact analysis. But it is important, as Executive Secretary mentioned, to really take stock of what has happened. What are the implications of these developments at the national level, regional level, global level? Because we can expect a lot of realignments and shifts, and this uncertainty that these trade policy measures have created, that adds another whole dimension to the whole macroeconomic, capital flows, and other aspects of economic development. So with that, if we look at today's session, the first part, as was mentioned, is going to look at what has been the impact at various levels, and we have some leading experts to talk about it. And the second part, we'll see how do we actually move forward, how do we mitigate the impact, and what are some of the measures that countries need to take. It's not just about the trade shocks per se, it's actually a time to build greater resilience and to be better prepared for other kinds of shocks, given the sort of fragmentation and uncertainties that seem to be growing over time. It's not just this one particular development that we need to look at. In light of that, let me just highlight a little bit some of the internal analysis that we've done before we move to what the experts will be talking about in terms of their impact assessment. Some preliminary work that we have done here shows very clearly that there could be significant impacts on certain countries, those obviously which have a less diversified export basket, greater dependence on certain markets, those which are more integrated into value chains, so downstream, upstream effects will be there, and the trade exposure could be much greater than what the immediate sort of tariff incidence shows. So it's important for us to take stock of what these countries are. So we find, for instance, the poorer countries, many of the LDCs says these are the ones that are likely to face a greater impact. And if you connect that to what the macroeconomic impacts could be, especially given the very concentrated effect in certain sectors such as textiles, the job implications, the poverty implications, and so on could be significant. Of course, none of us know after 3 months what exactly is going to happen. There are potentially some trade deals that may happen. Yesterday, US-China, there's a pause for 90 days again. But we can take different scenarios and try to assess their implications. What we take from this preliminary analysis is the importance of regional cooperation, sub-regional cooperation, continued need for bringing down trade costs, continued need for regulatory harmonization, adoption of best practices. Having said that, I think I should not, take up more of your time, but I'm really looking forward to this discussion. So Alexei has laid down the ground rules. We have 12 minutes per panelist, followed by 2 discussants in this particular session. And then I will come back to all the panelists with some questions emerging from their interventions. So without further ado, let me start with our first panelist, Dr. Jung-Woo Kang. He is Director, ADB Regional Cooperation and Integration Division, Economic Research and Development Impact Department. He will be drawing upon some of the ADB analysis based on regional exposure of countries to these tariff measures. Over to you, Dr. Wong.
Thank you, Rupa. Thank you for your kind introduction. Let me try to share my screen. Can you see my screen?
Yes, we can. Please go ahead.
Okay. Yeah. Thank you for the invitation to this very important webinar to discuss the implications of the new U.S. trade policy around the changing landscape of the trade and other economic policies. And so first, I'm trying to show that. Okay. So the various institutions have released the latest economic uncertainty indicators. So in this slide, I'm trying to show how much the global economic policy uncertainty index has surged in recent months or weeks. And then in particular, the U.S. trade policy uncertainty, so which historically has surged around the time of the new U.S. presidential election in 2016, 2020. But the level of the surging level of the heightened U.S. trade policy uncertainty has been unprecedented and in recent months right after the new U.S. government took office. And although historically the trade policy uncertainty has not been closely associated with any changing trend of international trade, but this time around, the scope and depth has been, again, unprecedented, and even the duration is still uncertain. After the 90 days pause, what's going to happen to the reciprocal tariff schedules announced by the U.S. as of the April 2nd? That's adding another level of uncertainty for the future of the trade. Based on the high-frequency data, which can be herald, precede the future trend of the international trade, also pointed to the compressed level of the freight levels, so around the uncertainties of the trade environment, as you can see from this chart. We can basically focus on the country level exposure to the U.S. reciprocal tariffs, which were announced as of the April 2nd. And then in this chart, we are trying to show the relation, both the x-axis and y-axis. First, each country's exposure to the U.S. based on the 2022 and the 2024 average, which measure the country's exposure dependence on that country's export for the US. And on the y-axis, we are showing the reciprocal tariff levels which were announced by the US. As you can see from the chart, the countries which are placed on the northeastern side of chart are expected to be more exposed to the negative impact of the US reciprocal tariffs compared to those placed in other segment of the chart. For example, Cambodia, not only the country is subject to the highest level of reciprocal tariff, which was the 49%, but also the country's export dependence on the US was more than the 36 or 7%. So which means that Cambodia could be under the quite serious strains in terms of both the export dependence upon the US and then the higher level of the reciprocal tariffs compared to other countries. And then likewise, Vietnam and Sri Lanka and then Bangladesh, to a lesser extent, could be exposed to the relatively more risks in terms of the potential impact from the reciprocal tariffs from the US. On the other hand, the Laos, PDR, and the Myanmar, although the level of reciprocal tariffs were quite high for those economies, but those economies, the export dependence upon US is relatively low. So which means that although the tariff level could be higher, but overall the negative impact to those economies could be more limited than that for the other economies on the northeast segment of the chart. While the reciprocal tariffs could be a good metric to assess the potential direct impact of the US tariffs against US trading partners, but under the hood, we need to also think about the both direct and indirect channels of the impact of the reciprocal tariffs by the US, because the value-added production of certain countries, while some portion of those can be landed in the US directly, but some value-added exports are going through third economies, through the global value chain. For example, many countries are exporting intermediate goods to third countries and manufactured there and to be re-exported to the US, ultimately landing in the US. So in that sense, for example, although the Cambodia is subject to the 49% reciprocal tariffs, direct reciprocal tariff from the US, but the Cambodia intermediate goods are being exported to the China, other ASEAN member countries, and other part of the region and the outside of the region. And then those indirect value-added exports will be subject to different level of reciprocal tariffs imposed by the US. So by that sense, we need to estimate the different channels of the value-added exports to be affected by the US tariffs, so which could be a better metric than the direct tariff exposures, in the sense that the value-added exports will be the source of the production and the job creation and the employment. So those will be a good metric in guessing about the potential negative impact to the economy. So on that front, in the case Cambodia, the direct reciprocal tariffs was the 49%, but the weighted average of the indirect tariffs, which are again based on the indirect valued exports from the Cambodia going through third economies, was a bit lower, much lower than the 49%. Then the total overall average of direct and indirect tariffs by the US for the Cambodia is estimated at around 45%. Likewise, Vietnam, Sri Lanka, Laos, PDR, all will be subject to a different level of the weighted average of the reciprocal tariffs by the US based on both direct and indirect the value of the export to the US. Although many of the countries are subject to the higher level of direct reciprocal tariffs, but on the bottom part of the chart, for those countries such as the Mongolia, Philippines, Bhutan, Australia, Kyrgyz, Nepal, and Maldives, Singapore, for those economies, the indirect tariffs of the US reciprocal tariffs are even higher than the direct reciprocal tariffs. This means that these countries are more exposed to the indirect channel of the US tariff policy than the direct channel. On the right-hand side, based on the direct and indirect the weighted average of tariffs by the US, we have tried to calculate the tariff exposure out of the GDP share. So based on this metric, Vietnam seems to be the most exposed in terms of the US reciprocal tariff schedules around the world as a share of the GDP, the country's GDP, followed by Taipei, China, Thailand, Fiji, and along this order. We can even further decompose the direct and indirect impact of tariff exposure as a share of the GDP for each and every economy. Based on that, again, the Vietnam seems to be the overall the most exposed to the reciprocal tariff by the US. But other economies, for example, Mongolia and then Australia, and even Laos PDR, those countries seems to be relatively more exposed to the negative impact through the indirect channels in terms of the being exposed to reciprocal tariffs by the US. On the right-hand side, we have also decomposed what could be those third economic channels through which each and every country could be exposed to the US reciprocal tariff threats. For example, in the case of Laos, PDR, Mongolia, Bhutan, and Singapore, many of the countries' indirect channel of the reciprocal tariffs are coming from the ASEAN, other ASEAN member countries, as well as the PRC. For example, in the case of Mongolia, the blue block, which represents its channel of being exposed to US reciprocal tariff through the PRC, accounts for the lion's share of its potential impact channel. So in that sense, Mongolia could be exposed to the reciprocal tariff threat by the US the most through the Chinese channel. But for example, in the case of Singapore, not only the PRC and the ASEAN, third economic channel, but also EU plus UK, third economic channel seems to be quite a significant channel for the Singapore. This means that Singapore is exporting a lot of the intermediate goods and services through the EU and the UK, ultimately landing in the US. Although this session is mostly about the impact, the angle of the US tariff policy, but I wanted to bring up some potential policy implication as a segue to the next session. The regional value chain integration in Asia and Pacific has deepened quite substantially over the past decades or so, both backward and the forward linkages based on our analysis. For example, many countries have strengthened their backward linkages, but other countries such as the Brunei Darussalam, Mongolia, even China, Korea, and Japan, they seem to show even the longer forward linkages within the region. This means that those countries are mainly commodity exporting countries, or they are the key supplier of intermediate goods or the key materials to the other trading partners in the region. On the right-hand side, we have also looked at the historical patterns of the changing degree of the both backward and forward linkages, regional value chain linkages in the region. Overall, the most of countries have strengthened both their backward and forward linkage over the past decades or so, for the past 2 decades. There are a few exceptions, for example, PRC, Bangladesh, and some other countries. For example, PRC, although its forward linkages in the region has strengthened over time, but the backward linkages have weakened over time. This does not necessarily mean that the PRC's backward linkages inside Asia has weakened in an absolute magnitude. This means that the PRC seem to have been sourcing more resources and intermediate goods from outside the region than inside. So this regional value chain metric is measuring the progress of the backward forward linkage in a relative sense, not absolute sense. So regional trade integration, we believe that should and could offer a buffer against the negative impact of the external shocks, in particular the unexpected shocks around the trade front. We try to draw some implication about the ongoing trade FTA, the efforts inside the region, and in the Asian Economic Integration Report 2025, which was released in March this year, we have included one snap analysis about impact of the FTAs in Asia. Actually, this left-hand side chart was cited by The Economist a few weeks ago, and then under title of the, for example, the not only Trump but Asia has its own problem with it, FTAs, something like that. Then this was very, I mean, I think that the article itself was citing our analysis from our report. Then on the left-hand side chart, as we are showing, the inter-regional Asian FTAs are covering the fewer provisions, around the 28% of the 52 key provisions for the FTAs. This is much lower than the non-Asian FTA agreements, which are covering around the 39% of key 52 provisions. And when it comes to the number of the members of the FTAs in Asia, the average number for the intra-Asian FTAs are much lower than those outside the region. So this means that both in terms of membership and scope, FTA seems to be covering less number of members as well as the narrower scope of the provisions within the FTAs. So this translate into the limited trade promotion effect of the FTAs actually. Then by engaging the so-called structured gravity model, we try to estimate the potential trade promotion effect of the existence of PTAs, as well as the breadth of the PTAs for comparing those within Asia and outside. As you can see from the left-hand side chart, intra-Asia FTA, both existence and the breadth seems to be yielding the limited trade promotion impact compared to those outside Asia. What does this mean? This means that currently the FTAs in the region have limited impact in terms of promoting the trade, and potentially due to the shallow commitment levels and the complex administrative requirements and the so-called noodle ball syndrome, which are due to the overlapping network different PTAs, in particular around the rules of origin requirement. And going forward, we believe that implementing effective trade agreement by simplifying trade rules and deepening the commitments, concession commitment, and then the aligning rules of origin criteria with the regional production patterns, and enhancing the awareness among the businesses, and reducing compliance costs should have the priority for the policymakers in pursuing and promoting, and then the positive trade promotion effective free trade agreement inside the region going forward. Let me stop there. Thank you very much.
Thank you very much, Dr. for highlighting what are the different kinds of exposure that countries have in this region, both the direct and the indirect exposure that exists through value chain linkages. Also, important point that you made, that not only is this underscoring the importance of regional trade integration and cooperation, but the fact that these agreements themselves need to be much more effective, much wide in scope, much deeper in terms of their commitments, if really they're going to be used to counter some of these kinds of uncertainties and shocks that we're seeing. So thank you very much. I have questions which I will come back to later. Also, please, everyone, if you have questions, put them in the question and answer box, not in the chat. Experts will answer your questions in the chat box itself. I mean, not chat box, the Q&A box itself. Now over to our second panelist, Professor Peter Draper. He is the Executive Director, Institute for International Trade in the School of Economics and Public Policy, University of Adelaide. He'll be talking about the geopolitical implications for GVCs in the Asia-Pacific region. Over to you.
Thanks very much, Rupa, and thanks very much to you and ESCAP for the invitation to be with you today. I also have a presentation, so I'll get it going. So I was asked to talk about the impacts of recent geopolitical dynamics on regional and global value chains. So this will be a political economy perspective. And I think it's important to start with the perhaps obvious point that global trade cooperation has actually been deteriorating before Donald Trump came to office, and particularly since 2008. And there have been a few punctuation marks in that overall process. First and most obviously, the failure of the Doha round to conclude successfully, the subsequent disengagement, I would argue, of developed countries from the WTO, as well as being combined with some developing countries' reluctance to participate in multilateral trade negotiations or the subsequent plurilateral negotiations. And as a result, a general stasis in multilateral trade negotiations. And so the WTO has been drifting for some time with a few successes here and there, but it's a long way from the heydays of the Uruguay round. And then on the financial front, we also had, obviously in 2008, 2009, the global financial crisis and a subsequent populist backlash, particularly in Western developed economies. And you could chart that path through to the rise of Donald Trump and other populists, but Donald Trump particularly for the first time in the United States. We've also had a series of geopolitical disruptions, not disconnected entirely from the finance and economic side. So first of all, the reorienting, many would say, of the Chinese economic model around President Xi in particular. And much more recently, two major black swan events being the COVID pandemic and Russia's Ukraine invasion. And throughout all of this, we've had increasing global warming. So climate change and addressing climate change has become more and more urgent. And also from around 2015, globalization or the tapering off of the growth of global trade relative to global GDP has also been taking place. So there's been less dynamism in the global trading system in general. And you put all this together, and in response, we've seen a mushrooming of selective trade and industrial policies emerging in many countries and taking many different forms, and obviously having implications for global value chains. So if we now start to unpack that a little bit, and if I were to adopt a term, it is that global value chains de-risking is now on everyone's radar. And this takes three key forms, I think. The first is the geopolitical drivers of global value chains de-risking. And we see this reflected in particularly import barriers and the mushrooming of import barriers. First round of trade wars under the Donald Trump 1 administration, carried through into the Biden administration, and under the Biden administration, the tightening and extension of export restrictions, particularly on dual-use technology products such as semiconductors. And of course, the intensification of inward investment restrictions, but also in the United States, the adoption of novel forms now of outward investment restrictions, and particularly into China. So all of these have implications for the operations and conduct of multinational companies, and by extension, global value chains. The second driver for me, this relates to the sustainability agenda, but goes beyond that, it transcends it, is what many are calling the level playing field agenda. So from the standpoint of the European Union, for instance, which adopts a robust human rights agenda and a strong labor market agenda, and seeks to enforce that domestically through the operations of its domestic companies and companies operating in the European Union market. And this affects those companies' supply chains. And so we've had supply chain laws mushrooming in the EU, most recently the Corporate Sustainability Due Diligence Directive. And these have human rights as environmental due diligence requirements, which have become pretty strict, although they are now under review, at least in the European Union. And again, of course, a strong push towards environmental sustainability, particularly in the EU, which sees itself as a climate leader. And that's taken various forms and has affected various value chains. For example, the EU's deforestation regulation, which has been paused recently, but also the carbon border adjustment mechanism, and one could continue. And the aim here really is to level the playing field, so to speak, for EU companies, because the operating conditions for those companies have become more compliance-oriented, more costly, and therefore, from the European industry point of view in particular, that playing field needs to be leveled through imposing externally facing policy measures such as a CBAM. And then throughout all of this, it's never really gone away, and it kind of comes and goes depending on what's happening in the environmental space and climate-related shocks particularly, but also COVID, so pandemics. It's the supply chain resilience agenda. And beyond that, many countries being concerned in the process and beyond about over-concentration of import sources or of suppliers, relationships, and over-dependence on one or a few export markets. To take Australia, for instance, the dependence on the Chinese market, and particularly of iron ore exports. And you put all this together, and what we had going on in the trading system for some time is a disintegrative trend that has been increasingly challenging supply chain optimization. And we've seen a number of manifestations of this. These bubbles just reflect a few. So these days, we're all talking about economic security and how to build economic security implications into the management of our economic and trade exposures and risks. For example, in the trade of critical minerals and investments into critical minerals, dual-use information technology products, and then the use by the major trading powers of trade coercion instruments. We saw this in Australia in the context of the COVID pandemic, when trade coercion instruments were applied to us by China. And the reciprocal tariffs are the latest manifestation of this. In this case, it's the US applying trade coercion instruments, tariffs particularly, to the rest of us. Data security has been an ongoing issue that's never really gone away. And the essential medicines, PPE, that emerged through COVID, that's still bubbling under in a number of countries. Coming specifically to the United States, it's important to pause and ask, in these bilateral reciprocal tariff negotiations, what exactly is the US asking its trading partners to do? Now, from my understanding, the US is also obliging its negotiating partners to sign non-disclosure agreements, which is an interesting innovation in the context of a bilateral negotiation. So we don't really know, but from what I'm hearing, there are basically 4 sets of demands. So the first is for the trading partner to somehow moderate its exports to the United States and or increase imports through purchasing arrangements, for instance, or dropping its own tariffs in order to balance, from the US point of view, the bilateral trade deficit. We also know that in March, the USTR issued its latest National Trade Estimate Report, and 4 key trading partners identified a range of so-called non-tariff barriers that it's not happy about. So all of those are on the table too. Thirdly, that the USTR and the Treasury, and these negotiations, of course, are being led by the US Treasurer, Scott Bessent, they want to remove barriers to digital trade and investments by US digital companies. And so that brings things like data security, in Australia's case, how we regulate our social media policies, etc., into the mix. And then the fourth, which is possibly of most consequence for the operation of global value chains in our region, that is, it seems to be a firm US demand that trading partners de-risk certain exports going to the United States from the trading partner concerned, Cambodia, for instance, from Chinese content, Chinese sourced content. And so this is a kind of unique innovation. It's a China ownership rule as opposed to our normal local content rules that we're used to in the context of a liberalizing free trade agreement. In this case, the US is raising barriers and requiring us to impose a China content rule of origin. And given China's centrality to global value chains, and of course the Chinese government's understandably predictable response that they're not happy with this, this puts many trading partners in very difficult positions indeed. Now, just on that front, if we think about this a little bit, so if I were negotiating with the United States representing, let's say, a connector country in the Southeast Asian region, such as Vietnam, I would make the obvious point that not all value chains are strategic. In fact, most value chains are not. And for those value chains, it should just be business as normal, subject, of course, from a US point of view, to those trade deficit concerns that they have. But for the rest, which could be deemed strategic, they will increasingly be affected by geoeconomic posturing. So China plus one strategies. What does that mean in practice? I guess the next session will get into that to some extent. And basically what this is forcing is a lengthening of supply chains, adding to costs, of course. But if we were to ask which value chains are actually strategic in some sense, I could identify four probably. The first, most obviously, would be military-related value chains. Jake Sullivan, the former US National Security Advisor's small yard, high fence framing. But the problem is, of course, the yard is widening all the time and the fence is becoming much higher. But this would apply to dual-use technologies in particular, and especially the IT sector, and that's a vast array of products, of course. Secondly, health-related products, connecting this back to the pandemic, and we've seen the US say, and they're investigating this now, that they want to rebuild their domestic pharmaceutical industry, and that has something to do with the pandemic, of course, and these security-related concerns. And then food security, or in some countries more honestly, sovereignty, is becoming more salient, and particularly in the context of the Russia-Ukraine invasion, where we saw major disruptions to grain exports from Ukraine in particular. And then finally, of course, becoming more strategic all the time, I would argue, is energy security associated with the green transition and who will control those technologies of the future. So now, finally, last slide, what is then the new normal for the countries in the UN ESCAP region, and in fact for all countries, I would argue, subject to reciprocal tariffs, which is all of us, including the penguins that I had up on my screen earlier. So the new normal basically means we all have to think much more smartly about diversification. And what does trade diversification mean? Well, it operates via changes in three overlapping choice sets. So who we trade with, both exports and imports, what proportion of that trade could be deemed strategic and is maybe at risk, is the first part of the calculation, for example. And then what we trade, so what is the mix of goods, services, and the extent to which value is added locally, and can we optimally promote more value addition locally, but without going protectionist ourselves, which I think that's a very important balance to strike. And then finally, how we trade, and particularly taking into account and harnessing the shift to services, digital transactions, e-commerce, etc. So in conclusion, when it comes to the diversification agenda, there are many choice sets. They have to be tailored on a country-specific and economy-specific basis, but still there is a lot of scope for diversification. And I will end on that point. Thanks, Rupa.
Thank you very much. Extremely insightful presentation. Thanks for actually laying down the context that, these trade measures have come suddenly. However, there's been a gradual development in terms of fragmentation, or as you call it, disintegrative trend that's been growing over time with the rise of industrial policies, de-risking, globalization, etc. Also, very interesting point you made about these bilateral trade deals. Everybody's been discussing about, every country running and trying to sign a deal, but what's exactly going on is not very clear. And I was wondering while you were talking that whether this non-disclosure element is something that starts permeating into future agreements as well when you have asymmetries in terms of negotiating capacity. So that's an interesting point. Also, I think taking from Jung Woo's initial presentation on the indirect exposure through value chains, and now you've gone a bit deeper into that in terms of the different types of value chains and what you could consider strategic and what are just normal business as usual. However, with the potential of creeping protectionism as well, when you say a small yard and high fence, the yard becomes bigger and the fence becomes even taller. And of course, the very final point on diversification strategies, as we saw, countries that are more dependent on single markets or just a few markets, very concentrated trade baskets, they are the ones most vulnerable. So resilience is key, but smarter trade in many different ways, and how much more we can use actually services trade, digital trade, etc. These are potentially opportunities. I will come back to some of these issues in my next round of questions. So thank you very much for providing very interesting insights. Now over to our third speaker, Dr. Badri Narayan Gopalakrishnan. He is the founder of Infinite Sum Modeling, LLC, and he'll be discussing some of the modeling related results he has from his general equilibrium estimations for Asia Pacific economies, North America, as well as India. Over to you.
Thank you very much, Dr. Rupa, and thank you for having me here. I don't have a PPT, but I'll discuss some of the analysis that I've been doing recently on this issue, and as the speakers who spoke before me already explained, this is a very evolving set of policies and a lot of uncertainty there. So given that there are a lot of different scenarios that we have been working on based on what have been announced and what are being discussed now, and the negotiations that are happening on a day-to-day basis. The first part I would briefly talk about some analysis we have already published, that is on India-US agricultural trade under this new trade policy changes. And this is actually about the US tariffs on Canada and Mexico and China, and some retaliations that happened until March. And also that was one scenario. Another scenario was about the steel and aluminum tariffs that were imposed across the world by the US. So in these two scenarios, of course, the impact on countries like India depends on two things. One is to what extent the tariffs are directly imposed on these countries, and second thing is the indirect tariffs that one of my co-panelists spoke about before. And then the indirect tariffs are like how these countries do not face only these tariffs on their exports directly, but also through the global value chain interactions. When we look at these different scenarios, what we see is that there are two broad effects that can happen. One is the broader contraction that can happen in the US economy and also the global economy, given all these uncertainties, given the price increases and the global supply chain interactions. That would have a negative impact on exports from most of the countries in the world, if not all countries in the world, to the US. But the second effect could be the trade diversion. So the countries that are not facing much of an increase in tariffs from the US, like some of the African countries, some of the developed countries, and so on, which only face the universal 10% tariffs, those countries can make some inroads in terms of taking up some of the slack created by reduction of exports from the other countries. That is something that we also see in our modeling exercise. For example, when we look at the scenario where US imposes tariffs on Canada, Mexico, and China, and then they retaliate. In that scenario, countries like India can actually benefit slightly. It's not much, but it's a very small amount, but it's still, there is some positive impact possible. Similarly, the steel and aluminum tariffs that were announced in a couple of months ago, the countries which are not so dependent on those commodities exports to the US, like again, India as an example, they can actually gain because of that. And that's a broad sense we got from the earlier announcements. With the recent announcements, particularly the universal 10% tariffs across all the countries, and particularly high tariffs on China, which of course have been passed as of yesterday. But when you look at these tariffs, we look at two things. One is just the impact of those tariffs when they were announced, and that itself, when you look at the global impact on GDP on the entire world, that is pretty substantial, around close to $1 trillion. If you also take into account the retaliation, it is a little over $1 trillion. So we see that kind of impact at a global level. And again, even in this case, some countries get affected much more than the others. For example, the US itself gets affected a lot. And Canada gets affected significantly, China, and many of the smaller economies which are highly dependent on the US as a market, and most of the ASEAN countries, and even some of the other developing countries, like some of the G20 countries in Latin America, and even some of the European countries. So, and this is interesting because most of the countries which may see a contraction in the economy because of these tariffs are the countries for whom the tariffs are not very high, like that even the countries that faces 10% universal hike in tariffs, even they see a contraction. That is because when I started the discussion, I mentioned about two effects, right? One is the contraction effect, and second is the trade diversion effect. So the contraction effect is dominating in many of these countries. And we also see that there are two other things that are happening. One is the price increases that happen because of these tariff increases, and these percolate into multiple countries through the global value chains. That is one aspect. And second, which we also talk about in general in the narratives, is the oversupply. Because of, for example, Chinese exports falling in the US leads to oversupply to other countries. So both of these things happen simultaneously, which may lead to increase in trade deficit in many of these countries, because on one hand, they face an inflationary pressure, so the domestic industry is unable to cope up with that. On the other hand, you have this oversupply and the lower prices coming from some of these other countries. So the imports increase a lot, whereas the exports and overall GDP doesn't increase so much. This is particularly talking about the situation where you look into the price effects also. So I think these are the main broad findings that we got, and look forward to further capturing some of the analysis, some of the policies that have been announced in the last couple of days. I look forward to more discussions. Thank you.
Thank you very much. Very complex sort of scenarios that one has to build in. And of course, one can add on then the macro sort of policy scenarios, also how countries react to all of this and what happens to capital markets, exchange rates. It could be quite an interesting set of different scenarios you could try and simulate going forward. I guess you would be looking at the 90-day pause for China, and with China having also just the same level, right? And how the diversion. Yeah. Okay. So thank you very much. So now I would like to kind of go back based on, some of the issues that have been highlighted. One common question that I would like to first put to all of you is, in every crisis or every shock, there is always an opportunity as well, right? One could think of this as a shock to kind of speed up some of the internal reforms that countries need to do, some of the restructuring they need to do of their trade and their partners, look at new opportunity areas, etc. So just very briefly, each one of you, your thoughts regarding where the opportunities could really lie. And you could talk about different groups of countries because Asia Pacific is such a heterogeneous region. So where do you see the main opportunities for both domestic reforms, trade reforms, diversification, etc.? Maybe I'll start with you, Peter.
Sure, thanks, Rupert. Look, I think you hit the nail on the head. I think the biggest opportunity really lies in that unilateral toolbox, so to speak. So if I reflect on Australia's trade reform history, back in the 1980s, we were a very highly regulated, a very rigid jurisdiction. And at some point, Lee Kuan Yew described Australia as the white trash of Asia, which riled a lot of Australians. But the Australians seized the nettle and reformed. They really reformed and opened up. And there was a 2-decade productivity boom as a result. And we think about China's economic success in the past 3 decades that was driven by reform and opening up. It's only really since President Xi came to power that process has been reversed. And we've also seen the growth rate tailing off, although the economic model now is very different to the Australian one. So I think when the US comes to you and says, here's our list of NTBs, and we want you to reform this set of policies, the first question the policymakers should ask is it in our interest to do this? And actually, if it is, then the next question is, can we blame the Americans? Because if we can blame the Americans and they take the political heat, it gives us cover to reform. So I would approach it from that point of view, that I can apply to regulations, but also reducing tariffs, etc.
Thank you very much. Jung-Woo, your thoughts regarding where you see the opportunities for the region?
Yes, any type of the tariff barriers will be causing harm to the welfare of the people and the region and beyond. But at the same time, I'm just wondering what kind of quick trade deals will be struck between US and other trade partners. For example, so if those kind of trade deals are going through the form of some SNAP, the free trade agreement, the small scale trade deals, then it may be a stepping stone to promote more liberalized international trade scheme, depending upon how the U.S. trade partners are responding to that kind of push from the U.S. For example, if some of the countries are pressed to lower their tariffs against the U.S. cars, for automobiles, for example, then what about the EU's interest in exporting their cars, Mercedes and BMW, those kind of cars, to the importing countries? Would those importing countries will be under the similar pressure to what they were under the U.S. From the other trade partners like the U.S. and other parts of the world? And eventually, although the U.S. the current stance is kind of the fundamental deviation, detraction from the MFN, the principle, but it may, in some sense, can be a stepping stone to push the importing countries to lower the tariff and the non-tariff barriers, not only to the US, but the other trading partners, in case that kind of momentum can be built. Thanks.
Yes. Thank you. Yeah, a lot hinges on what is exactly going to happen in these trade deals. I think nobody's really clear, and given the difficulties usually in sealing trade deals, how quickly can we expect something, especially with some major economies being involved in these supposed negotiations that are happening? Badri, very quickly, your reactions to that question, and then I can move to the discussants.
Yeah, thank you very much. And I think one important thing that we have to keep in mind is that although these changes are happening very quickly and negotiations are happening, some common understanding should happen among all the countries in the world. Maybe the Asia Pacific region can take a lead on this to basically really spell out the implication of this in terms of the WTO, the multilateral trading system, the regulations that we have all agreed upon globally, and how these things are being undermined now. So I think that's something that has to happen. That's one thing. And then this can be a common ground for all the countries to come together and make this statement, because all of us are in a way affected by this. And the second thing, a very different perspective, is about countries to what you mentioned about reforms, and also technological changes, efficiency improvements, productivity improvements to reduce the costs, actually, because the tariffs are not in our hands anymore. So tariffs are going to be going up and down, but basically, what can we do? What can the countries do in terms of reducing their costs? So that is something that is in their hand. So because that way, even the tariffs are high, they can still be competitive. So I think these two broad things I think should be kept in the thought process.
Thank you. Thanks for highlighting the importance of still continuing with bringing down trade costs, the role of trade facilitation, for instance. But of course, the other point on collective action. Collective action is always a bit of a problem. How do you coordinate everyone? As you can see, everyone's trying to do their unilateral sort of bilateral arrangement with the United States, and ASEAN is the only one that has gone as a grouping as such. Okay, thanks a lot. Now let me turn over to the discussants. We have Dr. Neil Balkin, Economic Advisor, Trade Policy Analysis, International Trade Policy Section, Commonwealth Secretariat. Thank you.
Thank you so much, Chair, and good day to everyone. It's a real pleasure to be able to join you today, and greetings from the Commonwealth Secretariat. I just want to start with congratulating all the panelists for the very insightful presentations. I think it's really added a lot of value already. And I'm glad in a way that I get to follow on from Badri's presentation, because I wanted to speak a bit more specifically about some of the impacts that we see for small island economies. We know with the very unique economic structures that those countries have, we want to hone in a little bit on how they might be affected going forward. Some of the panelists have already highlighted certain issues. I think, for example, Zhang Wu pointed out that Fiji will be among the most affected by the indirect and direct tariff effects. So the first point I wanted to make was that there is a real risk that small island economies will be disproportionately affected. And I think there are four main reasons for that. The first is what I alluded to already, just the unique structural vulnerabilities that these countries face means that they're inherently less equipped to deal with trade shocks of this nature, particularly given they have very remote locations and they're geographically dispersed, they have limited productive capacity and scope for economies of scale. They often lack diversification in their exports as well. So they really are heavily exposed. And we've seen in the reciprocal tariffs that were announced and then suspended that some of the small island economies in the Asia Pacific are amongst those facing the highest tariffs potentially. Fiji at 32%, Nauru, which is a tiny country, at 30%, Vanuatu at 22%, give you some examples in the Pacific. And I thought what was really interesting is that most of these countries account for such a very marginal share of the US's trade deficit. There was some work done by UNCTAD, for example, that shows that for Fiji, it's 0.019% of the US's trade deficit. Vanuatu, I think 0.001%. And Nauru, I think, doesn't even register unless you go many decimal points down. So that just points to the fact that these countries are not really who the US should be targeting if you do agree with the fact that the trade deficits are an issue for the US. The other point I wanted to make in relation to the disproportionate effects is just how heavily the small island economies depend on external trade, and also a strong and fair multilateral trading system, which I see in the chat has been raised as something that's very much under threat already. So the latest developments are just, I think, pushing further into that realm of the questions and threat to the rules-based multilateral trading systems that we see. And this is especially problematic for small island economies who really depend on free-flowing trade to compensate for their small markets and the lack of domestic production capacity and these other structural constraints that I mentioned. So I think this is just going to exacerbate any effects that they do face. Another point I wanted to make around the island economy specifically is many of them have very limited power or leverage to negotiate a deal with the US as well. And were they to retaliate, that could bring considerable risks given the lack of diversification in their economies and the limited negotiating power that they have. And also, I think it's just given their size, any retaliatory effects also be unlikely to induce any sort of positive response for the US potentially. So just to hone in on some of the potential trade-related impacts that I see for small island economies, I think one of the most concerning issues potentially is a loss of export competitiveness. I've mentioned the high reciprocal tariffs, which result in very large differential duty rates with some other developing countries in particular, and that could result in distributional changes around the structure of global trade, which could see small island economies further marginalized. I think another point, which I believe we touched on in some of the other presentations, but maybe could be expanded on, is just the issue of the impact on imports and imports becoming more expensive for small island economies in particular that are very, very reliant on imported goods. So that could be some area of particular concern. Speaking to some of the wider economic implications, that link to what I've just said, I think there's a real concern around impacts on cost of production for domestic producers in these economies, given the higher costs of imported imports, particularly affecting competitiveness in agriculture and other productive sectors. That Badri touched on some of the implications for agriculture already. Some point which is related to all of this, which I think is potentially the biggest concern, is around implications for food security from rising prices of imports in particular and any restructuring of value chains that does occur. We know that most small island economies are net food importers, I think almost all of them in the Asia Pacific region. So that's something to watch. In terms of wider economic implications, I'm also mindful of potentially some spillover effects on other sectors like tourism, if we do see higher prices due to trade protectionism and resulting in reduced consumer spending, which could affect tourist numbers. We know tourism is such a key sector in many of these countries. Another point, which I don't think we've really touched on today, but I think is very important, is the broader implications for investment, not only in small island economies, but for countries generally. We know how linked trade and investment are. and many countries in the developing world rely very heavily on inward investment. And some of the small island economies are very reliant on inward investment, specifically from the US. For example, I looked at the greenfield FDI flows from 2021 to 2023, and announcements originating from the US accounted for 44% of these flows to Fiji, 17% to Singapore, for example. So to the extent that the tariff policy impacts on the global investment flows and some investment location decisions, that could have very real impacts on investment into developing countries and small island economies in particular. There's also the scope for broader macroeconomic implications. I mentioned in impact of higher prices and inflation, but also I think a big issue for developing countries is the higher cost to service debt that could potentially result from these changes as well. And this is also not occurring in a vacuum, because we've already seen other challenges to the global economic system and the global trade landscape. For example, foreign aid cuts by major donors. Investment flows have been quite weak for several years now. And if you take all these impacts together, they could reverse some of the development progress that we've seen in SIDS, but across the developing world more generally. Maybe I'll close on just where I see a few opportunities, so we're not being completely negative about everything. But I do see some potential to focus on trade and services. I don't think we've spoken about that much yet. But particularly in small economies, with the rise of digitally deliverable services, they're quite well placed to supply services to a bigger market. And services are currently not in the sort of firing line for tariffs. I think there is some scope there, notwithstanding the potential knock-on effects of tariffs and goods sector on service. So we do need to keep that in mind, obviously. And I think it might just be the push that some small island economies need to try to diversify both their production, but also their markets and supply chains. So there's been some mention I see in the chat already about focusing on regional trade. The RCEP obviously offers big opportunities within the Commonwealth space, which is of particular interest to me. We see a lot of scope to boost intra-Commonwealth trade, which in the Asia Pacific, for example, is quite regionally focused already, with smaller economies, particularly looking to link into, for example, trade with Australia and New Zealand, and the larger economies in the Asian bloc as well that are members of the Commonwealth. And then I think just lastly, my final point would be perhaps an opportunity to recalibrate relations with the United States. I know I said that some countries don't have much negotiating power, but in some cases they do. I think of Fiji, for example, which is a really strategically important location for US security interests in the Pacific, and whether they can leverage some of that influence that they have to try to negotiate a better outcome, particularly after the 90 days have passed. So I'll leave it there, not to take up any more time, but I'd be really happy to follow up with any questions that might arise. Thank you very much, Chair.
Thank you, Neil, especially for focusing on the specific vulnerabilities of the small island developing states and the tremendous asymmetries that they're going to face. They're not going to be at the forefront of these deal making that's happening, but also finally highlighting some of the opportunities that could be there in terms of trade and services and digital content delivery. I think the larger question that you've raised, it was in the chat as well, which is about the undermining of the multilateral trading system altogether. And where does this take us? Is this going to be the new normal, sort of lots of these kinds of bilateral deals, and the marginalized become more and more marginalized in the process? Well, also, I think the larger macroeconomic implications that you outlined, definitely, I mean, we don't know how the inflationary effects or deflationary effects, because two different effects seem to be going on, what that means for monetary policy, interest rates, debt servicing costs. There are just too many unknowns, I think, in this whole package. So let's see at the end of the summer what really happens. And also for highlighting the investment implications, extremely important, because trade and investment go hand in hand. And with the value chain realignments, and even in recent years, what's been happening with the focus on de-risking and decoupling, etc., there is going to be an impact on FDI flows. So let's see how things get reconfigured again, uncertain. Over to my next discussant, Witada Anukunwataka, Economic Affairs Officer, Trade Policy and Facilitation Section, TIID ESCAP. Witada?
Yes, can you hear me?
Yeah. No.
Okay, thank you very much. I am going to discuss based on GVC perspective. On the modeling side, is a bit tricky, like what Badri mentioned, with several scenarios. I think scenario would be much more multiples with the current dynamics when we don't really know how negotiation will play out and how tariff facing each country will be. So that would be a tricky part. But for GVC perspective, I think that's pretty structured. And if we take it from the exposure point of view, as ADB presentation has pointed out, and actually ESCAP also looked into direct and indirect exposures based on value added in one of the blog which we share in the chat, and we're very happy that the results are very consistent. My key points that I would like to bring up from this perspective is first one, all the studies would have the implications that actually no country is safe, even if you don't export much to the US. Countries actually is the firms who face risks, right? Will be exposed to the impact if they are at under at least one of the following categories. If their firms are linked to the GVCs that eventually export to the US. So that is clear that there will be direct or indirect exposures, as the presentation has been highlighted. And then firms would be at risk even if you are part of the GVCs that serve for the purpose of made in the US. So that means even the domestic firm in the US would be affected. This is because costs will be higher at the end of this trade tension. With higher costs, demand will be under pressures, production will be cut back. So both the direct suppliers or parallel suppliers to that product lines would be affected. On these two aspects, the truce, the 90-day truce would mitigate the immediate impact to some extent. However, when it's come to the third type of the risk, where if you are a country that reliant on trade and FDIs, this kind of risk is already happened, and it is actually getting more and more pressures from these risks. Because when you rely on trade and FDIs, you need stability. But the policies right now is increasing the level of uncertainties, which means the risk premium is higher. So that would affect investment. There will be delay of investment to see what would be the best way to go. And that is the macro impacts that we normally have not captured, but actually it's real. So that's from this point, the real vulnerability is actually lies in how deep you are tied in the value chains that link to this kind of risks, and whether you are supplier at the upstream or you are doing things at downstream, or even if you are service provider, you will be falling into at least one or more of this category of link to GVCs or link to trade and FDI. And this also including US firms themselves. My second point is that we do impact analysis for designing policy response, right? But actually, the impact analysis, no matter it is modeling or it is GVC exposures analysis, we need to do at disaggregate level, which data usually limited us. So additional data like firm surveys or other type of custom data would have to come to complement. And the policy response will be designed on the industry level, on the type of product level. For example, if a country or a firm is doing low-tech products, these are kind of easily to replace products. Trade will be rerouted easily, especially if there are different levels of tariff. Depends on how good negotiation it is. So the immediate action for countries that are dealing mainly with this kind of products will have to rely on do their best with trade deals to secure market access. Other set of firms or other set of country may be more affect concerns on specialized products. That is good and bad on this type of product, right? This is hard to ship, but also it is hard to recover if the supply chain of this type of specializations is disrupted. And many of them are as target of the trade tensions because how the strategic of this product, the importance of this product. So this kind of products, policy response have to prepare for operate in parallel system because eventually the mainstream, we are seeing the decoupling, the parallel system coming to become a mainstream. And how to prepare for that, right? I think the key would be you would have to do, country have to do as much as possible to become strategic and trust partner. What does it mean by trust partner? In supply chains, trust partners are countries that have stable rules, stable policy, rely on rule-based systems. So that creates certainty in the policy environment, in the business environment. And trust partners are less likely to impose sudden export bans or violate contracts. So again, it is about rules and governance. And trust partners has to share security, regulatory, and political alignment. This part is a little bit difficult in the current dynamic because it means you have to be a bridge of two systems, be bridge, be connectors, not be collateral. So cooperation in regulatory dialogues on both sides or on multiple sides would be an asset. The best background for aligning regulations with multiple partners is trying to align with international standards as much as possible. Unfortunately, in Asia Pacific, the fact right now is we are quite fragmented. For example, in digital trade regulations where ESCAP has been done quite a number of research. We saw several type of data governance rules, several practice in IP protections. So this kind of rules alignment and more dialogues to base it on international standard has to happen. This is not yet include another set of standards and regulations that related to ESG, which going to become one of the key for future direction of trade deals and trade negotiations, and also cybersecurity. Being a strategic partner is also important to deliver in terms of value. So rather than focusing on low cost, country has to prepare for build up capabilities and trying to put your firms into system integrations, meaning your firms has to be part of the core design or core innovation rather than just doing in the production line. So this where would be the policy response for the example of policy response on different type of products. And then my third point is that governance issues will become a next fault line in addition to tariff. And the governance is, in another terms, in Trump keywords, is the non-tariff barriers. And non-tariff barriers that we will be dealing with is going to focus on digital, sustainability, and security issues. Countries that lack of clear and integral rules will be at risk of marked as non-trusted partner or be excluded from trusted value chains. So this again reiterate that the region's economic weight for Asia Pacific would lie on enhancing the enforceable and interoperable of rules. Regional initiative like, for example, RCEP or DEPA or APEC forums would be important to create coordination and enhancing the commitment to create alignment and alignment not in terms of to one side or selected side, but alignment with international standard and multiple partners at the same time. Thank you very much.
Thank you, Vitada. Thanks for highlighting the many channels of impact, as well as how we need to take a nuanced sort of approach to some of these issues. A very quick question, last round of questions to all the panelists. I know, Jang-woo, you have to leave, so a quick question to you. In the chat box, I saw most people have raised the issue of how to strengthen regional cooperation mechanisms, frameworks, and you also touched upon it regarding the FTAs and what needs to happen. How do you see the scope for regional integration in this region, improving what needs to be done, and how can ADB, an organization such as ADB, actually enable this process?
Yeah, but thanks for the question. I think that, although there are a lot of the challenges coming from outside the region, within the region, there are a lot of the new initiatives that are being taken. So it was mentioned by Neil that the RCEP and the CPTPP and other types of free trade agreement, also on the finance, the Assembly 3 level, the same IM, other types of the collaboration are being pushed and pursued. I think that the only thing that we can consider is that why don't we think about the broad scope of the cooperation mechanism beyond the bilateral, trilateral free trade agreement or Assembly 3 level, perhaps the Pan-Asia type of the free trade agreement and the Pan-Asia financial cooperation type of thing. So we are thinking about how to replicate Assembly 3 level the financial cooperation to other sub-regions like the Central Asia, South Asia. So that kind of expanding scope of cooperation or replicating one successful example to another sub-region within Asia could be a good stepping stone to the deepen and expand the scope and the level of the regional integration in the region. Thanks.
Thank you. Thank you. I'll let you go, though I, of course, had a question on whether there is capacity to do that and is the geopolitical environment rife for such a broad sort of Pan-Asia agreement, given the sort of differences and frictions we are seeing. But thank you very much for your insights. Quickly over to you, Peter. Where do you see the risks going forward, given this precedent that has been set in terms of striking these bilateral deals and this non-disclosure, etc.? What does it mean for the WTO?
It's not good news, is the bottom line, particularly because the UK did not make its concessions on an MFN basis. I worry about India, whether India will do the same. And not just those two, but obviously those two are very important. So, my strong advice will be whatever concessions you make them on an MFN basis, unless, of course, you're changing a regulation. That's obviously different. That's domestic. But for tariffs, MFN, please.
Yeah, do not undermine the basic principle of the multilateral trading system.
Exactly.
Yes, that's why I asked the question on setting precedents. And Badri, because of this importance of regional cooperation and integration frameworks that we have you looked at how these kinds of arrangements, say an ASEAN bloc or having a CPTPP or RCEP membership, how that impacts or helps mitigate the effects of these kinds of shocks? Do you see any difference?
Yeah, definitely. I think the one thing is this existing blocks, within them, there can be some, trade diversion, some growth that can happen. But then, one trend that has been happening recently is the expansion of these blocks. So when, like we just talked about WTO, so we need probably if these blocks result in like they become this building blocks where you get something close to the WTO. That has to be the ultimate ambition. But in the short term, I think they do have some positive impact on navigating through this kind of crisis.
Okay, thank you very much. And finally, Neil, any last words you would want to make on capacity building, because especially for SIDS, and we're talking about negotiating agreements, diversification, where can international organizations help in terms of capacitating them?
Sure, I think there's a significant scope to help there. I think one of the key challenges is just how rapidly things are developing. I mean, it's very difficult for us, even as trade experts, to keep track of what's happening on a daily basis, particularly given the uncertainty. And it's been a key feature of our discussions today. So I think international organizations, and to an extent they have been doing so already, is provide very timely analysis of key developments and their potential impact. I think that's really, really valuable. But I think on a country-specific level, there is scope to support negotiations, requests from countries to identify priorities, and where there's a realistic chance to, for example, get concessions from the US and other countries. I think there needs to be some support there for countries, particularly in such a rapid response environment, what can be done. It's very challenging for countries with limited resources to be able to, get that analysis done quickly. And I think that's really where international organizations like the ESCAP and others can step in to fill the breach, so to speak. And I will just add that we have a Commonwealth Small States Office, which is based in Geneva, which provides this sort of support to our small states in their negotiating, particularly to the WTO, but also on the bilateral level as well. So that is the avenue that is open, particularly to Commonwealth member countries as well.
Thank you very much. I think I will not try to summarize here, but clearly some common messages are coming up. We need to keep waiting and watching all through the summer to see what happens after the 90-day pause, what sort of deals are negotiated, whether we are setting precedents, whether we are undermining certain basic tenets of the multilateral trading system. A lot at stake. And I guess a lot of analysis for all of us to do. But I think the message that comes through for me most clearly is that keep trying to cooperate at the regional level, sub-regional level, build on the mechanisms that are already working, take those best practices, try to keep harmonizing regulations, adopt good practices, etc., and use this opportunity to whatever extent to reform your economies, to push down your barriers, to become more competitive, bring down trade costs, etc., to try to make the most of this crisis. But of course, a lot of differential effects across countries. Not all are well placed. So therefore, there is a need for international organizations, regional organizations like ours to also step in and try to assist them with informed evidence-based policymaking sort of analysis. So thank you very much to all the panelists for excellent discussion, and thanks to the audience for the many, many questions. I can see that it's generated a lot of interest and many of them have been answered. Thanks once again. Over to the MC. Thanks.
We will have 10 minutes break and we will resume the second sessions at, less than 10 minutes because we will resume at 3:40 p.m. Bangkok time. So 5 minutes from now. Yeah,
Yes.
yeah. If you're
Shall we
ready, we
start?
can start. Yes.
Yeah, I am ready. I just would like to see the speakers as well, if they are ready for session 2, maybe.
Hi, Mia. Good afternoon, Mia. This is Mustafiz. Can you hear me?
Yes, Mustafiz, we can hear you very well.
Okay, good to see you.
Yeah, great, fantastic. And I see Henry is there as well. And
Hi,
let's
Mia.
see if Deborah is there, and Jay is there. So we are all accounted for. Vitada, if you wish, we can start.
Yeah, I think we can start.
Okay, are you already recording, right?
Let me
Yes.
check.
Okay, good. So welcome to what is labeled as session 2 of this event. And for the interest of those that are joining us only now, let me just very briefly say that this session is focusing on exploring and identifying some strategic policy options for the Asia Pacific economies. In the first session, we have listened to presentations that addressed a sort of how to deal with coming up with the impact of the policy change that we are witnessing for the last 3 months or a little bit longer. And those presentations included both quantitative and systemic impacts assessment, and discussions was very vibrant. I don't know if you can still access the question and answer. Maybe you can get some gist of what was talked about. Now, I do want to make some introduction also, piggybacking on what was said in session 1. One, importantly, that we, although we have this tsunami of policy changes in 2025, we are all aware of the changes that were, sort of slow lava moving since the financial crisis, or maybe even earlier. But perhaps they can be divided or put into three baskets. One was the change of, and in particularly through the pandemic, from efficiency seeking to resilience seeking in among the firms, but also a sort of positioning of government policies towards that. Another one was from basing the economic relations between countries on economic interests to security. And that is coming very much on the top of the discussions nowadays. And the third one, which is, I think, most difficult to deal with, particularly for the multilateralists among us, is the shift from the rules-based system of international trade to the power-based system. And that particular shift, of course, has resulted or is bringing with it a lesser transparency than what we were sort of going towards in the reformed multilateral system. And already we have mentioned in session 1, for example, insistence of not sharing information that are part of negotiating agendas. That is not new, but what is perhaps more difficult is that the partners that are like-minded also are not allowed to perhaps discuss the joint positioning on that. We also have in this context of moving towards the power-based relations, the insertions of the poison pills, as it was already noted in the context of UK-US discussions, recent discussions, and some other, of course, symptoms of this power-based relations. We also have to deal with volatility of markets. We have to deal with fluidity of policies, but also the lack, the void of necessary guidance and instructions to the traders, which of course increases the cost, increases the risks, and in particular harms the interests of smaller traders and smaller countries, definitely those that are well integrated into GVCs and depend on having proper information in terms of their decision making. So all of this is sort of the environment in which we need to find there are, of course, defining the challenges that we have, as it was mentioned and I think asked from us in the previous session and also in this one, is to try to turn these challenges into some opportunities for the Asia Pacific countries. And so I will be looking forward to hear from the speakers in this session about how this can be done, in particular for Asia Pacific economies. And we know that these economies are, well, most of them are considered to be small economies in the context of international trade. And so for such economies, trade and negotiations on trade are always strategic issues. So that's not new. What is new is that the sort of underlying rules for such negotiations are being shifted tectonically, and so the problems may be in lack of not only negotiating power but negotiating skills in how to deal with this. We have heard many comments previously about the need to try to resist to go one-on-one and to look only on their own interests, but to try to still adhere to the multilateral rules, at least towards the non-discrimination or most favored nation. So that would be part and parcel of the solutions that perhaps can be found for Asia Pacific economies, in particular if they are able to somehow find the common ground and negotiate from that perspective. So let me stop there with the introduction of this session. We have a wonderful set of speakers. We also have one speaker who needs to leave us potentially early, depends on how we will be managing the time. So we will give him the floor first. So that's Professor Henry Gao, who is Professor of Law, Li King Chian Fellow at Singapore Management University. So Henry, why don't you take floor for up to 12 minutes, please? And then we'll, just to announce, we'll go through the speakers and Deborah and Jay. And then I will perhaps ask a very quick question from three of you, and then we'll go to discussants, Mustafiz and Jan. So hopefully that is agreeable to you, and the floor is yours, Henry.
Thank you, Mia. Thanks to ESCAP and Rupa and Nutrat for the kind invitation. I'm very pleased to join this webinar to discuss some of the issues which arise from Trump's Liberation Day tariffs. I will discuss three issues in my intervention. The first is, what does Trump want? The second one is the reactions from China. And the third one is the broader implications to the world trading system. So after the Liberation Day tariff came out, there was a lot of confusion, and a lot of people actually ridiculed, for example, the methodology that the US used in coming up with the high tariffs that the US imposed against countries, some as high as 50%. But I actually tweeted on Twitter on the 7th of April, where I argued that most people misunderstood what the Liberation Day tariffs are all about. And that review has since been confirmed, especially in light of the US-UK economic prosperity deal signed recently. So let me walk through what people often got wrong and why that matters. First, I argue that the Liberation Day tariffs was never about the methodology. People got bogged down in the technicalities. For example, people were saying that this formula was wrong, and it doesn't make sense to simply use a factor of the country's trade surplus with the U.S. as the basis for deciding which tariff they would apply. But that is basically missing the point. The tariffs weren't about precision, they were about leverage. So this was a blunt instrument, deliberately so, meant to force countries to the negotiating table. And that is what we have seen so far. Second, it was never really even about tariffs. So I argue that actually Trump doesn't really care whether Vietnam's tariff on U.S. exports is 9.4%, which is the current rate Vietnam imposed against the U.S., or is 0% or anywhere in between. Because what he cares about the most is whether those tariffs, along with a host of other measures like non-tariff barriers, exchange rate manipulation, industrial policy, and so on, create what he sees as a kind of an uneven playing field, particularly when they benefit China or enable trade diversion. And third, this, I would argue, is the heart of the matter. I argued in that tweet that this isn't really personal with every country, except one country, that is China. Okay, so everyone else, Vietnam, EU, UK, even allied countries like Japan or Canada, are simply collateral damage in a broader geopolitical strategic competition between the US and China. So trade policy is just a tool of economic statecraft. So if we look at the US-UK economic prosperity deal, that basically confirms these 3 points that I made earlier. First of all, as we have seen, tariffs stayed. So there was no rollback of tariffs that the US imposed on Liberation Day. So if this were really about market access or market liberalization, we'd expect the progress on that front, but there wasn't. Of course, this is only the initial deal. When the US and UK continue their negotiation, there is a possibility that the US might want to propose something like 0 for 0, like what it proposed vis-a-vis the EU last time when Trump was in office. But whether or not most countries would agree to 0 for 0, I think that is still an open question. Instead, we see that the agreement focused on non-tariff barriers, right? So there were many provisions, for example, on technical barriers, on digital regulation, okay, and on supply chains and so on. And most crucially, there were the provisions on China. So there was explicit language about transshipment, about tariff evasion, and even about ownership of production facilities, and also cooperation to counter non-market policies. So as we can see, this is clearly designed with China in mind. So to sum up, what does Trump want? I argue that he wants to rewrite the rules of global trade, not for efficiency, but for strategic advantage. So basically to prepare the stage for the upcoming competition with China. So he wants bilateral leverage, not multilateral constraints, and the Liberation Day tariffs were designed in such a way. So the second issue is, how did China react? So on April 1st, before the announcement of the Liberation Day tariff, I was interviewed actually by Al Jazeera. And in that interview, I mentioned that two things would happen. First, most countries would rush to negotiate with the US rather than try to retaliate. And second, except one country, that is China, which would retaliate. And that's exactly what we saw. So we saw that all these countries, countries which some were hoping that would form a kind of alliance to stand up against the U.S. They didn't do that. Instead, they started a negotiation with the U.S. China, by contrast, hit back. So we see quickly the escalation of tit for tat tariff from 34% to 84% and to 125%. And there was also a lot of hoo-ha about that. But despite all this rhetoric, I was always of the view. So on April 5th, I actually tweeted on this. I said, despite of the tough talk, China would eventually cave in and came to the table to negotiate with the U.S. And the timeline I gave was latest by June. And as we all know, that is exactly what happened last week, right? So we now have a preliminary deal reached in Geneva, and that deal saw the removal of most of the retaliatory tariffs except 10%. So if you look at the deal, it is a bit unbalanced because the U.S. actually maintains in total about 55% in tariffs. So this includes the 10% that stays from the Liberation Day tariff and the 20% tariff on fentanyl, and also the original 25% tariff under Trump 1 when he was doing the first trade war back in 2018. China, for its part, retains only about 35% in retaliatory tariffs. So that includes 10% from the current round and 25% from 2018. So how would the negotiation evolve? I would argue that despite the surprising good outcomes from last week, we are probably going to see a lot of back and forth in the negotiation, probably stretching well into 2026. Because, as we say last time around, it is never so easy to negotiate between the two great powers. So why did China blink? And that is because China is really facing a kind of an uphill battle, as I argued in another piece that I published last month, which is called Can China Go It Alone? In that, I analyzed China's economic, political, and diplomatic conditions. And my conclusion is that actually, it would be very hard for China to hold out for much longer, certainly not before June, before it starts negotiations. And indeed, that, as we can see, is what happened. So we see China engaging, not because it wants to, but because it has to. And that is the leverage that I talked about earlier. And last point, what are the implications for the WTO and the world trading system? So all these trade war pose really hard questions for the global trading system. And we see that, for example, the long-standing principles like the MFN, the most favored nation principle, was breached, right? Because the U.S. tariffs were discriminatory against individual countries, and depending on which category you fit into, you would get 10% to 50% tariffs. It's all different. And second, the old tariff banning principle also no longer holds because the U.S. action clearly breach its obligations under the WTO to not to exceed its tariff bandings. And also, this raises questions about some deeper issues that we are familiar with in the multilateral trading system. For example, how how do we define like products? I mean, the traditional approach in the WTO is that like products, we only look at the physical characteristics of the product itself. We don't care who are the producers who actually produce these products. But now the US is seeing that, this cannot continue, because if you look at China, they produce a lot of products, but at the same time suppress consumption, and has a lot of subsidies, and that cannot be continued. And the last point is about the special and differential treatment for developing countries. And this time around, ironically, we see some of the most hardline defender of the SDT, such as India, right? India actually never agreed to reform the SDT. India said SDT is a treaty-sanctioned right for developing countries. But this time around, we see that India was actually quite willing to negotiate on a bilateral basis with the US by foregoing all these, special and differential treatment. They are not asking it anymore. So I think, ironically, despite all these clearly law-breaking, I mean, I'm a lawyer, so I can recognize Trump's actions as law-breaking actions by Trump, but at the same time, ironically, these might provide a great opportunity to restart the discussion on WTO reform. And actually, DG Ngozi of the WTO already said last week that there is now broad agreement among WTO members to restart the reform negotiations so as to reposition the WTO. So I hope that by the time we hold the next ministerial in March 2026, the members would have, realized that, the old system cannot continue. Instead, they are already starting discussions on how to improve the rules to take into account many of the things which should have been taken into account in the trading system. I'll stop here. Thank you so much.
Thank you so much, Henry. Quite a bit of food for thought, and I think some of your sort of assertions might have find some resistance among the participants or the speakers. So we may get into the discussion, but definitely very insightful. And as you yourself said, you were on track of what actually happened with the bilateral negotiations. So we'll see how it evolves further on. Without going further on that, because we'll come back to you, may I turn to our next speaker, Deborah Elms, who is the head of policy in Hinrich Foundation in Singapore. So Deborah, 12 minutes for you as well. Thank you.
Thank you very much. Very happy to be here. I was thinking about all the different ways that you might approach any discussion on trade today. And I think that there are two things that I'm going to cover now in this brief opening remarks section. Both of them have to do with, rather than looking sort of backwards or even forwards about what the US might or might not do or how we might engage with the US or not, et cetera. Instead, I'm going to say, what are the options that are on the table for both governments and the options that are on the table for companies? Because I think that's actually quite crucial for us all to be thinking about, where does trade go from here? Clearly, we're not done with trade. So despite all of the tensions, the uncertainty, the crazy policy options that have been selected in the last few months, we're not going to go back to somehow, making things yourself in your backyard. Despite some of the rhetoric from Washington, you're not going to all be grazing, chickens in your backyard and darning your own socks. That is not happening. Okay, so we will continue to have trade. The question is, what will it look like? And I think one of the things that has been so disorienting for all of us, and I'm sure all of us on this call, is the speed with which we have just watched 80 years worth of trade and economic integration disintegrate. Now, that didn't come out of nowhere, just to be clear. I'm not suggesting that somehow Donald Trump single-handedly upended the global system, as in there was no other reason for this to have happened. But I think it is the case that after he moved into office, and certainly after his Liberation Day tariffs on April 2nd, you could see in front of you a sort of turning point in history where up until then we had a certain expectation, not always matched by reality, but an expectation of the way that trade would work, the way that governments would interact with one another, the basic environment in which firms globally would operate. Most of that has now been upended. That does not mean it's completely gone. It just means that we now have to look down at the sort of shattered pieces of the 80 years worth of history and decide what makes sense for 2025 and beyond. And I think that is unsettling because no one thought it would happen so quickly. And it's also an opportunity to rethink, genuinely think about, where should we be given where we're at in 2025 and beyond. So let me just talk again briefly about what governments are up to and what I think companies can do in this time of great disruption. From the government perspective, what I find very interesting, and I'm always been grateful that I've spent 20 years now in Asia, and I'm especially grateful to be in Asia at this moment when this trade disruption is taking place, because unlike a lot of parts of the world where they may be paralyzed or they may be waiting to see what comes out of Washington or someplace else, Asian governments have already got in place a whole series of potential mechanisms to deal with one another. They have bilateral trade agreements, they have regional trade agreements, they have formal comprehensive agreements, they have sort of less formal ways of interacting. They do things like pilot projects. They do lots of different ways in which they have economic interaction. And I think that those are going to be more vital than ever. And so let me just point to a couple things that I see coming in the near term that's going to be extremely helpful. In addition, obviously, to whatever ESCAP does, which is great. There's also other trade integration activities. One of them is APEC, which is meeting this week in Korea. There will be a bunch of interest in APEC itself. APEC never gets quite the limelight I think it should get, but if there was ever a moment when you need an opportunity for informal dialogue, it is now. So thinking about APEC as a platform for that informal dialogue, where do we go from here? What are we thinking about? What are you thinking about? How might we either collectively come together, or how could we at least understand our positions? I think that's crucial. So that's happening this week in APEC. In Korea, that's very useful. On the sidelines of that, as always, there will be a lot of other meetings taking place. So a couple that I'm watching particularly carefully. Well, one, there are supposed to be bilateral discussions with the US going on. I'm not going to talk about those for the moment, except to note that they're supposed to be happening. But also there should be, as there always have been, sideline conversations at APEC among the CPTPP members, the Comprehensive and Progressive Trans-Pacific Partnership members. As you may recall, CPTPP or TPP was one of the pathways to the free trade area of the Asia Pacific under APEC. It has always proceeded with some kind of check-in at APEC meetings. I think this one that we're having this week is especially valuable because it's an opportunity for CPTPP members to come together, discuss this changing trade environment, and work with other players, like potentially the European Union. How could they have, not necessarily to join one another, but how could they help shore up support for trade and integration? How could they make sure that we do not see protectionism devolve beyond just the US? So how we make sure that we stay trade open vis-a-vis each other and not start to close in as a whole, because of course that would be a disaster for all of us. So I think there's some interesting interaction that's taking place as early as this week. There are other actions as well. There's a lot more activity now around RCEP, the Regional Comprehensive Economic Partnership in Asia, thinking about how do you trade with each other. There's a lot of discussions on digital trade and how do we build out a network of digital economy agreements? How do we expand the Digital Economy Partnership Agreement, et cetera? So I think there's a lot of space for governments in this region to double down on the fact that it's important, trade matters, integration matters, collaboration is important. And you cannot be an export-led region in a world of protectionism. So how do we make sure that we don't end up in a world of protectionism, because that would be deeply damaging for Asia in particular. So I think that's what government is up to, and I applaud them. It's challenging. It's especially challenging because governments are not set up to move at the speed of the Trump administration. So they're struggling to sort of keep up with that relentless pace. But fingers crossed, government's moving forward. We should see evidence of that very quickly. Again, starting potentially this week in this APEC meetings, moving into June, there's a whole bunch of other meetings, including G7 meetings in Canada, and other opportunities for trade integration. So watch this space. For companies, let me just speak briefly about companies. You know, trade happens because companies trade, not because governments say that you should trade, right? So we always have to remember that whatever you think at the sort of high level, US should, Canada should, Japan does, whatever, what you're actually talking about in trade is what companies are doing. And I think this has been a really difficult time for firms, especially firms in and around Asia, who are deeply intertwined with Asian supply chains. Much of that final output has been destined for the United States or potentially Europe, sometimes China, et cetera. But if the US market is becoming more and more challenging to deal with, either because of tariffs being too high, because the rules are changing too quickly, because the compliance costs are literally through the roof for companies right now, then firms are going to have to pivot. Okay, US, very lucrative, been a longstanding interest of ours. Maybe we pivot and we go somewhere else. So again, what does that look like? I think there are some opportunities there, but it will be real challenging. It will be really challenging because it's not easy to replace the United States as a major market with the other markets in this region. But I think that's where we see, for me, the connection between what governments are up to on this integration agenda and what firms are doing, where firms are going to need to look harder to find ways to lower the risk, ways to increase the certainty. And of course, it would be phenomenal if we could continue to rely on the World Trade Organization. That's not functioning terribly well either. So as an interim step, at least, could we have some kind of overlapping concentric circles of support by both governments and by companies to ultimately get us where we need to go, which is at a time of great disruption, moving forward with trade and economic integration. And so again, I'm delighted to be here to talk to all of you and happy to answer questions about what that model, what those models, I don't think there will be one model, there will be multiple models. What do they look like going forward? So thank you.
Thank you so much, Deborah. As always, you bring some clarity into these discussions. So thank you very much for pointing these two sort of lines of attack in our thinking and how we, of course, they will meet and they will intertwine, and because the governments cannot also independently of companies create any solutions without knowing whether the companies will be able to act upon that. But so we can take up some of the points that I would be in particular interested in, the pivot that you suggested for companies, and to ask where to, if you would be ready to perhaps hypothesize on that. Let us turn to our third speaker, Jayant Menon, who is from ISIS Institute in Singapore, and who warned me that he will be thinking very positively about these issues and bringing in actually a ray of optimism and silver lining. So Jay, you have 12 minutes to establish that particular line of discussion. Thank you.
Thank you. Thanks, Mia. I don't think I can do that in 12 minutes. So what I think, what I might try and do is actually do what I've been asked to do, which is to talk about the impact on supply chains. And let me thank ESCAP for the opportunity to do this, firstly. And we've heard already today, especially from the previous panel, from Peter Draper and from Vitada, on the likely impacts on supply chains. Of course, you know, you can't discuss these issues on trade policy without thinking about how they might impact supply chains. I'll try and focus in a bit more on ASEAN in particular, as I've been asked. And if I have time, I'll try and get to the silver lining issue, or maybe we can come to that in the Q&A. Right. Okay, so I'd like to start by providing a little bit of a historical context for all of this. It might be useful, particularly since ASEAN's manufacturing supply chains were really born out of a very similar kind of trade tension going back a few decades between the US and Japan in those days. So what we had then was very similar in the sense of a growing, unsustainable bilateral trade deficit. The difference, however, is that there was no trade war as such. The whole, all the tensions were resolved relatively amicably through what we know as the Plaza Accord, which was the forced appreciation of the yen and the Deutschmark, and to try and correct this huge bilateral trade deficit, not dissimilar to the one we now have between US and China. But of course, it didn't work. The bilateral deficit wasn't corrected. Some of it was shifted into the trade accounts of the ASEAN countries as a result of the shifting of investments and the birth of the current network of manufacturing supply chains. These were born out of that particular episode. And of course, they've evolved over time, but they were really given their initial birth by that particular, trade dispute or trade tensions. It's important, I think, to be reminded of this, because the reason why it wasn't fixed by the rapid yen appreciation was because the roots of the problem then, as in now, is not with trade policy. It's macroeconomic in nature. It's the savings investment imbalance in the US, both private and public. We have, and it's worse today than it was with a few decades ago when the problem existed with Japan. And so we have this huge budget deficit, and we have very low savings rates, both public and private. And you might argue that savings rates are too high in China and maybe in other countries where the imbalance exists. But the source of the problem remains a savings investment discrepancy. And so tweaking around with trade policy can shift your deficits around a little bit across countries, but it will not resolve the issue. So now let me turn a bit more to the current situation. And I guess it's useful to start with the obvious point that, a lot will depend on where we land in a few months, or maybe I feel it'll take a lot more than 3 months, the initial pause. I think this will have to be a series of pauses before we really come to any kind of agreement on, what's achieved. And even then, I think everything will be up in the air. And I'll come back to that later. But I think, a critical aspect will be whether US and China can negotiate a permanent reduction in the prohibitive rates that occurred, before the pause, agreed to in Geneva a few days ago. And it wasn't any trade deal that we had in Geneva. It's just a ceasefire. That's all, right? The deal is still to come. So let's wait and see. So in a worst case scenario, I guess we, end up with decoupling. That was what it looked like before the Geneva agreement. And I think, that's something that would be disastrous for the US, for China, for ASEAN, for everyone, right? A world of multiple duplicate supply chains is a huge resource waste. A best case scenario might see a return to the pre-Trump 2.0 tariffs. Maybe, we have to get used to 20% for China and 10% for everyone else. And that's the best case, I guess. But to understand how they impact at supply chains in ASEAN, I think we go back to recognizing how things were with the China-only tariffs, before the reciprocal tariffs were introduced. With the original China-only tariffs, there was a huge incentive to reconfigure supply chains to avoid this particular tariff. Now, the reason for this, and this is a story I keep telling because I think it's very important, the reason for this is because the tariff is applied on the total value of the import, but only a fraction of that value is added in China, right? So it's triggered by just a small percentage, but the amount of the tariff is a function of the total value. In fact, on average, and this is something I measured a few years ago, it's still relatively true, I think. On average in manufacturing, a so-called made in China product has about a third of its value added in China, right? Of course, this varies by product, but on average, it's about a third. So a 20% tariff, let's say, on China alone, means that it's effectively 60%, a 60% impost on adding value in China. This is the 1/3 dimension, right? So 3 times what the nominal tariff might be, right? So, assuming that this is a non-transitory tariff, then shifting out of China to, say, Vietnam makes economic sense as long as doing whatever you were doing in China can be done in Vietnam for no more than 60% of what it cost you. That's a huge buffer, right? And I think it explains a lot of the shifting and reconfiguring that we had seen leading up to, the new tariffs. But just before I start on the new tariffs, Biden, of course, retained all of what Trump had in place, Trump 1.0, and he did a lot more, right? He tried to clamp down on the workarounds by shifting the focus from ownership to location. So this is the shift from made in China to made by China, and also directly targeting firms, especially in the last or third package of measures that he had introduced. All of this was already in place before Trump's so-called reciprocal tariffs came in. And those tariffs, of course, were huge until a few days ago, where they went down from about, they went down by 115 percentage points, right? From 145 to 30, at least for 90 days. So what does this mean? This is interesting because actually 30% is higher than it was before Trump took office for the second time. But, Trump has now raised potentially tariffs on many of the other countries. I mean, Vietnam, it might be 48%. So we'll have to wait and see. But the gap with China, right, when it comes to the relocation buffer that I described earlier, could have narrowed. We don't know. It all depend on what comes out in the wash at the end of the pauses. But for the first time now, Trump has potentially raised tariffs, not just on China, but on all trading partners, right? So this is a concern, I think, when it comes to reconfiguration and what it means for supply chains in this region. But I want to finish off, and I'm aware of time, with this final point, and that is that all of this reconfiguration and impacts on supply chains that we now tend to focus on is driven only by one particular distortion, right? The tariffs and perhaps some other non-tariff barriers. But it's a distortion-driven impact. The key drivers, the main drivers of supply chain relocation before we had this Trump tariffs 1.0 and 2.0 and Biden, were always there, right? And these are the important things to bear in mind. These are relative costs, comparative advantage-driven relative costs, and other differences, such as access to scarce resources. Here I include technology, skills, and natural resources, including critical minerals and the like. All of these factors will continue to drive investments in supply chains and their reconfiguration and relocation. Supply chains were born out of disruption and they thrive on disruption. And these sorts of things will continue to drive supply chains in ASEAN. And as long as ASEAN sticks with its current position of non-retaliation and its long-standing commitment to openness. And by openness, I mean a non-discriminatory trade and tariff regime that embraces open regionalism and the MFN principle. So if ASEAN can continue and not be dissuaded by or will not be tempted by everything happening around it, I think supply chains will continue to thrive. But of course, again, a lot will depend on where we land in 90 days or so, or what happens after that. And hopefully we will end up in a position where we were before all this chaos started. So with that, let me stop. I didn't get a chance to get to the silver lining, but maybe we can come to that later in the Q&A. So thanks for your attention, and back to you, Mia.
Thank you, Jay. Thank you. Well, you were still not completely pessimistic, and so you managed to insert a little bit of hope in finding solutions with some conditionality on ASEAN. But let me turn back our focus to, I'll just have quick questions for three of you, and then let Mustafiz and Jan intervene, and then we can go into discussions among all of us. But Henry, since you are a lawyer, and we have noted this this really rampant step away from rules that we have been building, not only in multilateral system, but regional trade agreements, right? So the US had a number of regional trade agreements that is apparently not honoring anymore. So what are the lessons for ASEAN countries or for Asia Pacific countries in approaching bilateral trade negotiations with US in the context of how these agreements will be supported, what we will see in terms of perhaps negotiation in dispute settlement? Will that change? Or are we going to be accepting just unilateralism as the rule of the day going into future?
Thank you, Mia. That's a great question. Well, I think there are trade negotiations, and then there are trade negotiations. So for negotiating with the U.S., apparently now, as I mentioned towards the end of my presentation, all rules are gone, right? No longer MFN, no longer tariff banning principle, and so on. So you just have to do whatever the U.S. Wants from you. So that is the unfortunate reality. And the deeper reason for that is because the U.S., despite all these misgivings, is still the largest market in the world, right? U.S. consumption accounts for 30% of global consumption, even though its population is less than 5% of global population. So for the other countries, the only way they could, I mean, we hear a lot of talks about diversifying your exports these days, but if you are only talking about suppliers rather than buyers, I don't think there is a real likelihood of you shifting your exports. So I think what needs to be done is that all these other countries, including China, including EU and other countries, need to boost their consumption, which they are currently not up to task, despite their apparent eagerness to either deepen existing free trade agreements or sign new ones. Because if you look at the current situation, China, despite having 20% of a global population, is consumption is less than 10% of global consumption, and the EU is only like 13%. So that is less than half of the US. So unless that can change, I don't think there would be much point for these countries to sign FTAs. So I would say that the solution doesn't come from the legal provisions in these agreements. It must be an economic solution. Thank you.
Debbie and Jade, do you have any comment on what Henry was just saying?
I would just echo his point that it is difficult to replace the US as a final market. So while firms will say that they are no longer interested in dealing with the US, and certainly the China-US trade lanes up until this weekend were basically closed for an awful lot of trade in goods because the tariffs were simply too high and uneconomic to trade, it is difficult to figure out how exactly do you pivot away from the dependence on the US market. And if you choose to do so, there are consequences to that, especially for firms, which is, again, smaller markets, much more expensive, much more expensive to get into these other markets where you haven't had a significant presence, but also you're reducing the amount of margin that you're likely to get because no one buys like the Americans in the size, the quantity, the price, et cetera. And so even with a pivot, it is really difficult to figure out how to replace the US in whole or in part. And I think that is important for everyone to remember, that as much as you would like to not maybe go to the US, given the chaos, that the alternatives are not fantastic. And for some things, there really isn't an alternative. So examples that I've been giving, which I think are still relevant, is things like Halloween costumes and Christmas stuff. Nobody buys Halloween costumes, and certainly nobody buys Christmas stuff in the quantity that Americans do. So if you're not going to be shipping things to the US for Christmas, where do you send them? Nobody else needs a Christmas tree in the same quantities. So some things are easier to move. Many things are not. And again, we're in that period now where firms are trying to figure out what the alternative will look like. And the challenge for a company is that because these policies are changing day by day, the net result of that is often sort of paralysis. I'll cut down on my spending internally. I'll furlough workers. I'll lay off workers. I'll cut down on my inventory that I'm holding now. But that's not sustainable long run either. And so that again, the sort of disconnect between eventually we will have some kind of pathway by governments and the immediate needs of companies, especially the smaller ones, to have clarity. That's a big disconnect, and we'll see how that makes a difference in supply chains. But I can imagine that by the time we get clarity, whatever that is, the supply chains themselves will actually have been reconfigured because many firms will have simply gone out of business. Other firms will have pivoted to new business. And so you can't sort of turn the tap back on again and expect that you get back to where you were. I think every day, every minute that we have disruption is harder to recover from. And so we just have to recall that this prolonged period of uncertainty, which from a government perspective may not even feel that long, it's only 3 months, but if you're a company, I can promise you 3 months is an eternity to try to figure out how we manage to get from here to there another 3 months from now. That is really causing a lot of distress, even with, and especially the on again, off again nature. We're now on a pause, US, China, 90 days. What does that mean? Does that mean it's going to get extended? Does that mean the tariffs are going to go up at the end of it? Does it mean they're going to come down? We just don't know because we don't know. We're not investing. We're not really, especially we're not expanding. Most firms are not expanding, even if they are rushing to get as much as they can shipped as quickly as they can. this just disruption is going to continue.
Indeed, but also there is, I think, the question needs to be asked whether there is any potential, obviously not in a very short run, but any potential of incentives from the governments to companies to move into different sectors and not produce Halloween costumes and toys, but use their technology and workers, etc., to move into the production of something that will be perhaps sought in different markets, right? So it's a sort of, it needs a foresight from the government. And obviously now we are all more ready to look into use of industrial policies. Therefore, perhaps there is some space for that sort of thinking in the medium to longer term. But there is a pain and the problems how to deal with companies and their a sort of clearing the productions that they have with the markets that is currently closed, right? But I want to open another before I go. I'm coming to you, Jay. I just want to put another sort of stick into this wheel because the analysis from a French institute, CEPI, has shown that China actually control out of 5,000 products that include both final and intermediates, more than 700 products based on exporting more than 50% of such products to the world market. And the only far second is Europe with half of that product, when US is only controlling maybe 93. So what do you do with the supply? Because quite a few of those products are actually very necessary products for your supply chains to hold your resilience in. If you are somehow asked not to trade with China. So can I put that into the thinking, Jay, before and let you now comment as well?
Right. Okay. So let me come to that in a minute, but I just want to go back to what both Henry and Debbie were saying, and I agree that it is going to be difficult to replace the U.S. market, especially at a time when everyone or almost everyone is looking to diversify away from the U.S. market. When everyone's doing that simultaneously, then it's much more difficult, and this is something that we need to consider. But I think the discussion also has so far concentrated purely on the supply side, right? I mean, Americans are addicted to consumption. I mean, where are they going to get their Halloween costumes from? Can they survive without a Christmas tree? I don't know. I mean, I think what might happen is, we know that prices will rise. The question is by how much. A recession in the US might help reduce demand for all of these sort of discretionary spending. But I think, there's both the demand and the supply side, and we have to look at a new equilibrium where there's a bit less of both, but it's not purely a supply side driven story. And that's something to bear in mind, I think. Yeah.
You want to comment on the dominance of China in supplying the materials and inputs for supply chains?
Well, I think maybe the others are better at commenting on that. But I think it's related to what I'm just saying, right? I mean, again, some things cannot be produced without involving China, right? And the demands for those items are, other than completely elastic. I mean, you're going to basically have inflation, right? People will have to pay more for these things, and if substitutes are not immediately available, that doesn't include Chinese value added, and that's, I think, true for some products, a lot of products, perhaps. Yeah. And so we have a world in which welfare is reduced, prices increase, and for no good reason. Yeah.
Okay, well, I have to be mindful of my role as a moderator rather than a discussant. So I'll go back to our two discussants. The first one is Professor Mustafiz Rahman, whom we know from Center for Policy Dialogue in Dhaka in Bangladesh. So you have only 6 minutes, Mustafiz. Somehow I was given directives that discussants have half time of the speakers. So 6 minutes, please.
Thank you, Mia. Thank you, Rupa. And I was listening to Henry, Deborah, and Joyant with the keen interest and attention. Let me bring the perspective of a graduating least developed country, which is Bangladesh. We'll be graduating in November 2026. Bhutan has already graduated in December 2023. Along with Bangladesh, Nepal will be graduating, Lao PDR will be graduating. So some of the comments that I will be making will be common for many of the graduating countries because they will be transitioning to a completely different regime from preference-driven competitiveness. We will have to shift to productivity and skills-driven competitiveness. And all these things are happening at a time, the Trump tariff and the high inflation that followed in our countries after the Russia-Ukraine war, and Bangladesh for the last 3 years, we are experiencing double-digit inflation. So, and the Trump tariffs also comes in. So in Bangladesh, 37% additional tariff was imposed. So I think that first of all, for weaker economies like ours, a rule-based multilateral trading system is good. And I think we should refocus our attention to reinstating the WTO rules of MFN and the rules SNDT, special and differential treatment. So I think that should be the common stance of Asia Pacific countries, whether it is LDCs, graduating LDCs, or other countries. The second is that yes, I think there is a need. US remains Bangladesh's single largest exporting destination, accounting for 1/5 of our export. So you can see what implications it might have. And John very rightly mentioned, for example, for our ready-made garments, which is 90% of our export to the US, the value addition for many of the products is only 40 to 50%. So if you take, even 10% of tariff, it actually is an additional 25, 30%. On our value addition. So it's a big disruption really for us. So now going forward, I think ESCAP has also highlighted, what are the measures that we can take for the non-tariff issues, single window, logistics policies. And these are more than equivalent to the tariffs, the market access that we will lose. So if we can compensate on that, the non-tariff issues, the policies that we should pursue, and the second point is the regional trading arrangements. Bangladesh doesn't have any free trade agreement. Vietnam has more than 20. So I think that BIMSTEC FTA and also the current negotiations that we are hoping to have with ASEAN and RCEP, these are the ways to have. Maybe we should move forward actually to a pan Asia Pacific free trade agreement. But for a start, I think BIMSTEC FTA is a good start for us, and also with ASEAN that so we import more than 65% from East Asia, South Asia, and Southeast Asia, but we export only 12%. So I think that this is an opportunity. Crises are also opportunities. So how do we build our, strengthen our regional markets through triangulation of investment, trade, and connectivities, transport connectivity. So I think that is the way that we have to go forward. It's a very difficult time for us. Graduation is taking place at a very challenging time, but we will have to, with our partners in the region, I think we'll have to withstand the challenges that we are facing. Thank you, Min.
Thank you, Mustafiz. I think you are in the right house now. I think ESCAP has been working for since its establishment on actually providing these regional cooperation platforms and formal or less formal, but definitely opening the door for the lower income countries to sort of collaborate and find solutions with other countries, including financing and everything else. So I think I'll give floor to Jan Duval now, who is the Chief of Trade Policy and Facilitation section in the division. Perhaps he will also put some further information on how these least developed countries that are graduating may find assistance from Regional Commission, Jan, and other platforms that you are cooperating with.
Thank you very much, Mia. It's good to see you, and it was very good to hear all the panelists and also Mustafiz. Thank you very much for your insights. I mean, as a discussant, I don't know whether I'm supposed to react to everything that was said. Probably impossible. But I mean, from what Henry was mentioning, right? I mean, what I retain is really that. I think because we're trying to be positive, right? I mean, this is what's happening. Actually, it's that existing trade rules are being deeply undermined, if not destroyed, right? And then we have very high level of uncertainties, right? So we don't need to even speak about the tariff levels, the numbers and everything. I mean, as Deborah was saying, we just, like, from a private sector perspective, a business perspective, they don't know what's going to happen next. So how can they invest? How can they do anything? And governments is a bit the same thing, except it's related to only one market, which is the US, right? Obviously, it's the largest market, single market on the planet, but it's still just one market. So there's still many other things that can be done. So in terms of solutions, opportunities, I think I agree with Henry that there is an opportunity for a reset at the WTO to really kickstart something at WTO, because now there is really urgency, right? I mean, the system is being destroyed. And so whether a large enough group of countries can come and really discuss constructively, a new set of rules is a question. But it is an opportunity. Whether it will be taken up, I hope so, but I don't know. On Deborah, I think she mentioned quite a few regional cooperation mechanisms, right? APEC, RCEP, CPTPP, CPTPP, collaborating with EU, and deepening partnership with EU. And I mean, I think this is really the right way to go. I mean, you need to leverage existing regional cooperation infrastructure mechanisms, trying to deepen them, integrate them, harmonize them, in order to move forward quickly. Because if you try to start a completely new one, it's going to be difficult. I mean, ESCAP, as you know, Mia, have been discussing Pan-Asian regional cooperation and integration structure for many years, right? There's last 20 years, but very difficult to do. And so I think to the extent possible, let's build on what's existing. Then Jay, I mean, I think Jay, what I want to retain from what Jay mentioned is really that the concern he raised about the tariff, US tariff being raised on the smallest and the weakest economies. And this is a little bit of a tricky in my view, because we see, for example, I mean, China already, I mean, posed tariff, right, with the US to a large extent. And then UK already negotiated something, but how can the smaller guys can go and negotiate something like Cambodia and Fiji and Bangladesh? I mean, how can you go and I mean, how far down the queue are you, right? And so at the end of the day, I mean, it's going to be really up to the US government to decide what at the end of June, right? So no, at the end of 9th of July, I think it is, what's going to happen, right? And so we just hope that that at least the small economies, the weakest economies, will be spared, because it's quite damaging, and I don't see, really what they can negotiate, right? And then on what Mustafi's mentioned, I mean, again, I mean, that's related to what I just said, right? I mean, Bangladesh is a graduating LDC. So what, I mean, definitely needs to prepare for graduation. And then trade facilitation, I think Mustafi, you mentioned trade digitalization, single window. This is good. This actually works in normal times because you can reduce your trade cost by 10 to 20% by doing this. But that's actually not enough because we've just in ESCAP, we do a lot of calculation of the impact of trade digitalization, right? And then actually it's not enough to compensate for tariff of 30%, 40% and things like that, right? So yeah, it should be done. So very quickly, I mean, regional cooperation is the way forward, right? Leveraging existing platform, and then trade facilitation, reducing trade cost is the other angle I would like to stress, right? And then in terms of what ESCAP is doing in this area, so I'm just showing very briefly the ESCAP website here. So we do three things, right, in ESCAP. We do research and analysis. So we've done research analysis on the impacts and things like that. So this can be used. We do capacity building, and we do intergovernmental consensus and cooperation building, right? So in that context, I think one thing I can highlight here is TINA. So TINA is a trade intelligence and negotiation advisor. In fact, Henry, I think, is in our advisory board, Deborah as well. And it's an online tool to support trade negotiation, bilateral trade negotiation, regional trade negotiation, using evidence, using data, right? And so I encourage everyone to actually use this. And then we've developed a new tariff simulator that you can use to actually look at the impact of tariff. And they are changing all the time. So I think it's very good to have an online tool because you can see how it impacts your country. And so we try to keep it up to date. We updated it as 12 May. We did it based on the 12 May and the lowering of the China-US tariffs. So you can take a look at the results for your own countries. We calculated them, but it's also a tool where you can actually change the tariff and play around with that, right? The other tool I want to mention in ESCAP that I think is very relevant in the context of trade facilitation is a framework agreement on facilitation of cross-border paperless trade in Asia and the Pacific. So this is a UN treaty fully dedicated to trade digitalization, accelerating trade digitalization. Bangladesh is already a party. 14 countries around the region are already party to it. China, Republic of Korea, all the Central Asian countries. So I think I would like to encourage everyone to join this treaty because that provides one platform to actually work together in one specific area of trade cooperation, which is trade digitalization. Let me stop here. Thank you.
Thank you, Jan, very much, and thank you very much for putting the spotlight on these ESCAP products. I think they are very tools. They are very useful, particularly for developing countries in the region that may not have own capacity in getting to the quick and dirty sort of estimates of the impacts of these very sudden and continuous changes in the trade environment. May I seek the permission of the organizer to ask another round of short questions to the speakers, or do I have to close because we are sort of facing the deadline, the full hour that we are given?
See, you still have about 4 minutes.
4 minutes. Okay,
then
good.
is there a question in the chat? I think so. Maybe also you can borrow from that.
Yeah, so that's why I think I don't know if I was not looking at the questions in the chat, so I don't know if they were answered already by the speakers. And I don't know how quickly we can go through these, but I would invite perhaps the speakers to have a look at these and perhaps answer some directly or not. But I was going to ask really all of you just one question, right? Given what we were talking about in the context of this disparity of capacity of countries in Asia Pacific of handling negotiations with a big partner, yet being dependent on either directly through the exporting to that market or indirectly through the supply chain connection or forward or backward linkages. It doesn't really matter. Because we have to come up with some sort of options for the governments to take. What would be your one sort of suggestion to the governments of these lower income countries in Asia Pacific to pursue in the next six months or so up to the end of this year? Can I start with Henry first?
Yes, Mia. So which question is this? I was thinking of, since you asked us to look at the questions, I was thinking of answering Brad Williams' question.
Well, you can do that, but I would like you also to answer my question as well.
Okay. Yeah.
Yeah.
Yeah. Sorry. Your question, because I was reading this.
No. Okay. So why don't you answer first that question that you read, and then I will repeat my question.
Sure. Yeah, thank you. So I saw this question from my old friend Brad Williams. He was basically asking if a large number of WTO members can bring complaints and eventually threaten retaliation together against the US. And my answer to that, unfortunately, is no. I don't really see that happening. I mean, this strategy could work if the US is taking something like the steel and the aluminum, tariffs, right? Like what happened last time. So basically, the same tariff against everyone. Then everyone can, bring a WTO dispute together. But this time around, I think the U.S. is much smarter in the sense that they are not doing it by dividing and rule. So basically, what they did was that they have a specific number for every country, and the implication is that whichever country that conclude a deal with the U.S. first would be the first to get sort of a preferential treatment. A bit like what happened with the UK, even though with the UK, the 10% tariff is not removed, but I would expect that later it could be removed. So that is what we saw in this region too, where countries like Vietnam and Cambodia all rushing to negotiate with the U.S. So actually, this remind me of an old joke. When two friends go into the woods, and they saw a huge bear, right? And one of them started running, and the other guy said, "What's the point of running? You can never outrun a bear." And his friend said, "Well, I don't need to outrun the bear. I only need to outrun you." Okay, so that is, I think, the lesson for everyone in this game. So all countries are trying to, basically outrun each other by signing a deal with the U.S. first. So unfortunately, I don't think everybody would be bringing cases against the U.S. This time. So no, it's not happening. Thank you.
But isn't it, Henry, also that because the system as it stands now is not fully functioning, so even if you can't have this class action of togetherness, it would still take you to the first level, and given that there is no appellate body, you can't ever finish it, right? So
yes, that's another big reason, because of the paralysis of the appellate body. I mean, even if you can get a favorable decision, there's no way to enforce it. But of course, I mean, if sufficient WTO members want to bring a dispute, there is potentially a way of enforcing it. So that is essentially what the EU did, with countries which are not part of the MPRA, right? So if they basically appeal into the void. The EU said we are going to immediately retaliate against you, right? I mean, if the countries have the political will, they could do that. They could collectively retaliate against the US. But no, as I mentioned earlier, that's not what happening because every country regard each other as their own enemies. They just want to reach a deal before the others, so they can enjoy preferential beneficial access to the US market. So unfortunately, no. Yeah.
Thank you. Thank you. I'm being reminded that I have to close in 2 minutes. So I'm just going to give 1 minute to Deborah and Jay to say whatever they want to say in the end based on what we have discussed in the session. So
Sure.
Deborah.
Sure. Thanks very much. I'm just going to remind folks like Bangladesh that as bad as this is from the US, it's also relative. So you have to think about Bangladesh compared to your key competitors into the US market. And unfortunately, or maybe fortunately, they all got hammered. Cambodia's at 49, Vietnam's at 46, Bangladesh is very high, etc. So it's bad, but it's sort of equally bad. And if it gets reduced to a 10%, still bad, but compared to your competitors, you're still all equally damaged. And I think that should be also remembered, that it's as bad as it sounds, it's compared to others. It's not a silver lining, but at least it's worth remembering that it's you compared to whom.
Okay, thank you, Deborah. Jay?
Yes, I agree with that. I think it's the relativities that matter. And in this sort of global trade war, this global trade assault on all trading partners. But I think, for these small countries like Cambodia, this is not sustainable. I mean, to balance trade with the US, which is what the US wants, Cambodia has to increase its imports by 4,000%, right? It's just not, feasible. And so I think when the dust settles, the US will need to look at this and say, look, do we really care about what Cambodia is doing to our overall trade deficit? And do we really want to start paying that much more for our clothing and our garments and our leather products? These are not going to be made in the US. In any sort of economically sensible way, economic cost sensible way. So I think they'll have to then start becoming quite a bit more rational in the way in which they treat all of these countries, and hopefully that will happen. Maybe not in 90 days, but not too much longer after that. Yeah.
Okay. Well, thank you very much. I think let me just say a few words at the end, trying to end on this a sort of constructive way. I think we have heard enough to try to recommend to the governments in our region to use this crisis, not to waste it, but to use it as the opportunity to try to realign their domestic regulations and policies towards more efficiency and better governance. So that definitely can be used. In the past, we had different anchors for such reforms. Now we can use the unilateral sort of attack of US as the anchor for these sort of reforms to justify to some of the domestic vested interests that may not be benefiting from the reforms, that they are still needed for the benefit of most, right? And then we can also really push towards, I know that I haven't heard from you a very strong push for it, but still push for appreciation and adherence to the multilateral rules as they exist now. Obviously, we can improve on them. There is a time to seriously rethink how it can be approved, and perhaps to step away from certain stubbornness in terms of defense of some of the rules of the multilateral system to make it fit for for modern business and for new environments. So that definitely can be done if the country continue dialogue and cooperation using the platforms such as ESCAP. I think that is one opportunity. EPEC is definitely there and provides continuous a sort of innovative solutions and policies to different challenges in the in those countries that are then applied either multilaterally or in different contexts. And of course, we need to really be mindful of the countries that are not actually having direct access to such platforms, either APEC or CPTPP or RCEP, and that are at the margin and had to be because of humanity and sort of reasons of inclusivity brought into the solutions that can be found by these stronger partners. So I thank you very much for your insightful, almost optimistic discussions.